Why is it? Oh, I am recording. Yes. Can you guys see my PowerPoint I have up?
Yes.
Okay, awesome. So feel free to interrupt at any point in time and ask questions. If you're watching this virtually or watching a recording of this, thank you guys for hopping on. My goal today, I think that actually just recently I worked with a coach to go through my social media, and I think that I'm really good at explaining things in layman's terms. And she told me my videos feel like a little bit like Charlie Brown's teacher going womp 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 womp. And it occurs to me all the time when I'm talking to realtors and they're helping their clients navigate something and we're talking about appraisal gap or AUS or findings. They probably have no idea what I'm talking about. Or when they talk to any lender, they have no idea. But at some point, we all have this like, well, am I really going to waste the time to ask that question right now? Is that the most important thing? So, my goal today is to really dive into all of that to hopefully make a little bit more just common sense out of mortgage stuff. Sometimes we hear things, we learn things when we first get in the business, and then we don't remember it and no one ever takes the time to explain it to us again. So hoping to break some of that down for you guys today. If you guys haven't seen some of our new loan estimate tools, this is actually really great and really interactive for your clients. So it's a tool where we have all of the closing costs and true costs of the loan hard coded into the back. So when they log into a portal, you can log into the same portal and you can actually enter in the purchase price, the taxes, everything else. You can literally leave the same. If you adjust the down payment, it's going to automatically adjust mortgage insurance premiums based off of their credit, income ratios, all of that. And so it's a really nice tool. I think the biggest struggle most realtors have is it's a Saturday morning, your clients fell in love with the house. You go, great, there's 7 other offers. I need you guys to offer 350,000. Does that work for you? And they look at you deer in the headlights because the lender has only ran one summary and it was at 300,000. And so they have no idea what 350,000 even feels like or means. And so with this new tool, anyone can pop it in. Myself, the client, and the agent have access to the exact same screens so you can see what total monthly payment is and total closing costs are. The other thing I realize lenders do is we always tell you, oh, they really want their monthly payment to be about $3,000 a month. But then you have no context of how to get them to a $3,000 a month payment. So you have no idea if you're really hitting their goals for them or not. And so hopefully this tool adds some ease. And there's also an option here where you can issue a pre-approval letter on the fly as well. You just type in the address to the TBD and hit issue pre-approval letter. So hopefully, I'm always happy to send you a pre-approval letter just as fast as I can, but hopefully this even just saves you a couple minutes of having to wait for my phone call back, etc. Points versus no points. This is another big thing that comes up with clients on just like, why do rates vary? So if you're a realtor, we hear it all the time where the realtor's like, well, I send refer out 3 different loan officers. What's really confusing to your client is now they've talked to 3 people who hopefully are all doing a great job giving good service and educating your clients on how the market works. Or they've maybe talked to one person that did a deep dive into a bunch of stuff, another person who just quoted them general stuff via email, or another person who just sent them a pre-approval letter with no context. And so when people talk about interest rates varying, it's really confusing to understand like, well, Allison, I'd love all my clients to work with you, but so and so said your rate was higher. Why is that? Or do you not have the same loan offerings as someone else does? For most buyers, conventional FHA, VA, anyone under about a 760 loan amount, most loan options look all the same across the board. Every lender has the same interest rates that they can sell from Fannie, Freddie, or Ginnie Mae. At that point in time, it's really just how someone is marketing it. So, well, you've maybe heard points versus no points and the break evens, but how do you actually make sense of that to a client? This is a perfect example. This is right off of, if you type in Quicken mortgage interest rates or Rocket mortgage interest rates, you can pull this up. Most lenders right now are quoting interest rates with here, this says 1.875 in discount points, and it typically is assuming about 25% down. If you pay that, so what is a discount point? It means you're paying upfront money for your client, for yourself, to get a lower interest rate for the life of the loan. But if they're not gonna be in the loan for 30 years, then it probably doesn't make sense for them to spend extra money buying down the interest rate. So this is an analysis we run at every single pre-approval, and we show them, here's your interest rate. If you want the lowest number at cash to close, your interest rate's gonna be higher. If you want a lower interest rate, that's great, but your cash to close is gonna go up a little bit. And so we show them, okay, here you can see it takes 29 months of being in this mortgage before before you actually break even on that upfront money you've spent. So does that make the most sense? Again, I likely have the exact same program and loan options that Quicken Loans, Rocket Mortgage, Guaranteed Rate, Cross Country Mortgage. We all have the exact same conventional loan products. It's just how someone is marketing it to it. On Friday, we have clients who've literally been looking for a home since interest rates were 3.5%. They wrote an offer on Friday and in the final hour decided to shop around for some different quotes. We ran them numbers at no discount points because that is our strategy. We know that we want them to be able to refinance in the next year or so. They won't be in this mortgage for 30 years. And another online lender showed them a loan summary with 2 discount points, but the interest rate was lower. So they went ahead with the online lender and decided to write their offer with their pre-approval letter, and they didn't get an accepted offer. Maybe it was terms, or maybe it was because they had an online lender's pre-approval letter, and the agent felt like, my hands are tied. I don't even know how this happened, and didn't feel like she even had the expertise to explain to them, no, 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 it's all the same thing. Did you double check the points and fees? So when you have a client in that situation or trying to compare loan options, I always tell clients, if you're going to shop around, you need to compare interest rate and fees. Those two things are going to go hand in hand. And this is a perfect example of how people can market the same thing differently. And it can be just really confusing for the end consumer, especially if they're hearing it from 3 different loan officers. This is another piece of information we're always reviewing with clients at pre-approval. Oftentimes, agents are telling clients, I know rates feel high and I know prices seem scary, but it's still a good time to buy. What if market still goes up? What if, interest rates come down? You're gonna have all of these people go into purchase, but they don't have anything visual to actually show the client to make sense of why that would be a reality. This gives an example, this pie chart right here. This is Golden Valley, so Hennepin County area. Right now in the area, there's 106,000 people who are currently renting who can afford to purchase. And there's 421,000 people who are renting and can't afford to purchase. As interest rates come down, more and more of that light purple chunk of the pie are able to purchase. You can also see on here, there aren't a ton of homes being built in Hennepin County. 4,000 a year or almost 5,000 a year for 421,000 people is not a lot of homes. And we already anticipate homes to continue to increase in value. So if all of a sudden rates drop by 1% and all of these people can start qualifying to purchase a home, these numbers start to skyrocket. And in 1 year, instead of paying 4% higher for the same house, all of a sudden you might pay 8 or 9% higher for the exact same house. When they slow down, and sometimes real time will even calculate for them, what is 8%? What is 10% on a $400,000 house? And all of a sudden, a 7% interest rate doesn't seem so scary. A lot of your clients, if we're talking about a first-time buyer especially, probably is millennial age around early 30s. They grew up in a time where they were taught you owned a home instead of renting because renting was more expensive than owning a home. Your monthly payment would be less if you owned a home than if you rented. Now for most of our clients, when we run these analysis, their rent might be $2,200 a month. and their monthly mortgage payment might be, this example, $2,800 a month. So how does that really make sense for them, buying versus renting in the long term? And so we always go through this comparison. So this shows if they went to sell their house, so meaning they have to pay realtor fees, they have to pay title fees, they already paid closing costs for purchasing, what they would walk away from each year based off historical appreciation. So appreciation over the last 63 years, we average that out and we say this is what you would make if you went to sell your home in X amount of years. So even though you might be paying more every single month for the exact same home, or you might be paying more than you would be renting, how are you actually gaining wealth? Well, this is how, because if you look in 5 years, you would walk away when you sell your house with 6 figures in income. If you continue to rent for 5 years, you walk away from your lease with $0. So that's where the big pendulum swing is, and that's how you're really building wealth through real estate. Um, This one's going to be a little bit more long-winded. If anyone has questions, feel free to pop in at any point in time. But I'm going to start with key terms. I think a lot of realtors are just expected to know all of these mortgage key terms, and they actually don't really know what it means. So when we talk about down payment, sometimes they will come to us and they'll say, I want to put 20% down. Keep in mind when your client says that, oftentimes they have no idea about closing costs. I would say 9 times out of 10, they have no idea they're going to put money into escrow or have to pay closing costs. So usually that number ends up coming down. Make sure when your client is getting pre-approved that they do have an idea and someone has gone through them with them in detail with the total number for cash to closes. I think it's really important agents pivot the conversation from what are you comfortable with for cash to close? Has your lender reviewed that with you? Versus how much do you want to put down? Most first-time home buyers don't know that there's a difference between the two. And if the lender hasn't done a deep dive into numbers, you likely are writing an offer they might not be comfortable with come Monday morning and the lender starts running numbers for them. So cash to close. So that's the biggest. We always ask, what if you bought a house tomorrow, what would you feel comfortable with for cash to close? Meaning closing costs, escrow account, all of that included. Okay, what actually is in closing costs? Closing costs are going to range from 2 to 3% of the purchase price. Closing costs include all of the fees paid to title, all of the fees paid to the lender. If you're paying discount points or buying down the interest rate, that's included in closing costs. When someone says 2 to 3% in closing costs, 3% closing costs assumes that the client is paying 1% in discount points. So that already assumes some interest rate buy down, just so you know, a client doesn't necessarily always need a full 3% if they're not going to purchase the rate down a little bit. And then the other thing included in that is the escrow account. So the setup for the taxes and the insurance. Escrow, when I explain escrow to a client, this is exactly what I say. When you purchase a home, you know you're going to pay taxes and insurance on the house, right? Yeah, of course. Great. So taxes are specific to the home that you purchase. Insurance, you can shop around and choose whoever you want. But when we close on the property, and you go to the closing table, at first, there's no money being paid out yet for taxes and insurance. So every month when you're paying tax and insurance, you're not paying them into Hennepin County or Jake at State Farm. You're just paying them into this holding account, which is called an escrow account. And the mortgage company pays those bills when they become due. When you close, there's no money in the account yet. So we're really just building up a cushion for about the first year. So at closing, they'll pay for 1 year of homeowners insurance and roughly 6 months of taxes on the property at closing. And then in addition to that, they're going to put a little bit of cushion in to the escrow account so that when the bills need to be paid next year for tax and insurance, or in 6 months if it's taxes, that there's enough funds in that account. This is the biggest thing, guys. Even people who have purchased homes 4 times have no idea how their escrow account works. So make sure that if you don't have a clear understanding of that, that is probably the biggest thing clients get confused on. That is an easy thing. If you explain it just how I did, that seems to make people go, oh, okay, I got it. A lot of clients mix up appraisal and inspection. Of course, you guys all know what the difference between an appraisal and an inspection is, but sometimes the client can't wrap their head around it. So we always explain it as appraisal is a third-party service going out to the property to ensure that the home is worth what you're paying for it, so that if you were to default on your home or walk away from it, that the bank doesn't end up underwater on the house and it protects you from overpaying for the property. 2-1 buy downs. This is everyone's favorite thing to talk about, and temporary buy downs, 1-0 buy downs, and no one's really explained to realtors what they actually mean. When we do a 2-1 buy down, it is a temporary buy down. It is a normal 30-year fixed 30-year fixed mortgage. We're not looking at an ARM. It's not an interest only loan. It is nothing like that. It is literally a standard 30-year fixed mortgage, and the lender calculates how much less the payment would be if the interest rate were 2% low for the first year and then 1% low for the second year. Whatever that amount of money is gets held in an escrow account or a holding account by the lender and gets used to offset the payment every single month for the first 2 years. So that's literally all it is. It is not some different type of loan option. It is just calculating the difference between what the rate is at their 30-year fixed mortgage and what it would be if it was 2% lower, taking that money, putting it essentially in like a little savings account held by the lender, and they are dispersing it on behalf of the client every single month to keep that mortgage payment lower of what's actually pulling from their bank account every single month. So with a 2-1 buy down, we can also have a temporary 1-year buy down, which would be the same thing. For 1 year, it's 1% lower, and we're just offsetting that account every single month for the first year. Most clients hear this, and for whatever reason, they get a little scared that it's some type of ARM product or interest only product. It is locked as a standard 30-year fixed mortgage. If they end up refinancing or selling before the 2 years is up, the money that's held in the account just gets paid towards the principal balance of the mortgage. Paying points, we just talked about that one again. Paying points is spending extra money to have a lower interest rate. And then conventional jumbo FHA VA financing. Conventional financing is any 3%, 5%, 10%, 15, 20% down loan under a 760 loan amount. This is most of our buyers in this market. Jumbo financing is going to be any of your clients over a 760 loan amount. If you get into that price point where we're about 900 or above, you really need to watch because it's a totally different type of loan. For a lot of jumbo financing, we have to have what's called reserves. Reserves mean we have to show that a client has extra money sitting aside in a bank account, 401k, retirement, whatever, that can offset their mortgage payment for 6 months, 12 months, 18 months, whatever the investor requires. So that's money after they've spent their down payment, their closing costs, all of that they just have sitting somewhere that we can use in for what's called reserves. Most investors require a minimum of 6 months of reserves. If it's in a retirement account or something they can't touch right now, we can't use the full amount. We can use between 40 and 60% of what's in that account, depending on what type of account it is and what their withdrawal terms are. So if your clients are going to have an $8,000 a month mortgage payment, then we need 8 times 6 somewhere in a bank account. So that is a really key thing that people need to watch for on that type of financing to make sure that if you all of a sudden go up to that level, it's not going to mess up their qualifications. FHA and VA financing. So FHA is government backed. VA is obviously VA backed. FHA financing, we're not seeing as much of it right now in this market just because it is harder to get an FHA accepted offer, especially because FHA financing, you can do 3.5% down, but conventional financing, you can still do 3% down and you can still go up in a lot of cases to up to 50% of their gross monthly income. FHA, you can go to 56% of their gross monthly income. Still, 9 times out of 10, unless someone has below a 700 credit score, the conventional options are still making more sense for your average first-time home buyer than an FHA loan is, especially with how it's just a little bit trickier in this market to get an accepted offer. These are the questions I get called most with frantically on a Friday or Saturday morning. Okay, what if the appraisal is low? Totally depends on how you negotiate it up front. If an appraisal comes in low, the clients can pay the difference out of pocket, or a lot of times we can offset and just change what our purchase value is essentially, and it just kind of changes their loan to value. So if a client is putting 30% down, they can go all the appraisal could come in 10% low before it makes any difference to their financing. They're purchasing the house for the same amount of money. We haven't dropped below 20% loan to value, so there's no mortgage insurance. It does not matter if it comes in up to 10% lower. If we go below 20% down, now this is where things change a little bit, because if you go to 15% loan to value, there'll be mortgage insurance. If you go to 10% down, the mortgage insurance goes up a little bit. So then we really back into the numbers with the client of what makes most sense. What do they prefer? Do they want to keep their cash to close to be the exact same number? Or do they want to bring a little extra to closing to keep a lower monthly payment? I do have a quick 10-minute video explaining appraisal gap strategy. If you have any questions on that, feel free to send me a side note and I can send you that video as well. Why do interest rates vary? We chatted about this up front. Typically, it is only because of the way someone is marketing the interest rates. It is not that they are typically varying. Another example, this morning I have a client who called and they said, well, I talked to my financial advisor and then they talked to their person, they quoted me this, and they sent over what they quoted them. And I go, well, yeah, we're looking at totally different types of loans here. This advisor ran it at 35% down payment. You guys had initially told us you want 20% down. Those are totally different loan amounts, loan parameters that can widely change your interest rate. 9 times out of 10, clients just aren't comparing things apples to apples, which is where we're seeing the variable. What will an appraisal call for FHA or VA financing? Typically, the only things they're going to call for are true safety concerns, or FHA, of course, peeling paint. Someone asked the other day, well, what if there's wallpaper peeled off in a corner? The reason FHA calls for peeling paint is because they're worried about lead issues in the paint. It's a safety concern, not because of the aesthetics that peeling paint is ugly. So if something like wallpaper is ripped, that's okay, as long as there's no peeling paint that we're worried is hazardous behind the wallpaper. So, okay, there's an old roof. That's totally fine, as long as the roof is safe and habitable and the people are going to be able to move into the house and there's not holes or missing shingles, things like that, that there is no issue there. Paying points, we already chatted on this one. This is just when you're spending extra money to get a lower interest rate. Pre-approval versus pre-qualification. Pre-qualification means someone stated their information to me over the phone and I maybe pulled credit, maybe not even, and I just gave them a pre-approval letter based off of generic information they gave me. Pre-approval is when we've actually done our full due diligence and we've ran something called AUS findings. AUS findings, we've got this down here too, if you're wondering what that is automated underwriting system. So when we push through our system, every lender has the exact same program called automated underwriting system with either Fannie or Freddie. And they run it through a system and they tell us exactly what documents this loan is going to require, if they're okay with the debt to income ratio, how they like us to calculate the income, if we can get an appraisal waiver or not. All of that comes from AUS findings. So in order to get a full true pre-approval, we are running AUS findings on a client. Until we enter in a property address, we do not know if we'll get an appraisal waiver or not. So let's say this always happens where someone calls on a Saturday afternoon and they say, well, can we get an appraisal waiver on this property? Potentially, we have to know how much you're going to offer, because we only know when we put that address into the AUS underwriting findings if it's going to spit out an appraisal waiver or not. It's not necessarily dictated on the strength of the client's finances. Oftentimes it's dictated based off of that property. How long ago did that property sell? Is there an appraisal that's been done on that property within the last few years that's been registered with Fannie and Freddie that's pulling in their findings? And is the value in a line with how much that could have gone up in value? For example, we had one last weekend. We ran findings and the property was listed at 270, we could get an appraisal waiver at 285, but if we went to 286, the appraisal waiver went away. Exact same borrower, exact same finances, nothing had changed in the file. It totally is dictated on the property and what Fannie Freddie findings on the back end of their computer system feel is an appropriate amount for that home to trade at. Sometimes I don't think agents fully understand the differences between mortgage companies. So one difference, so companies like Guild, Across Country, Fairway Mortgage, a lot of these companies are ran similarly. We typically are going to have an in-house appraisal panel, so we're using our own preferred vendors for appraisals. We have our own internal in-house underwriting, and standard conventional FHA VA loans are all being worked on by our trusted staff. A broker, which is Edge Home Finance, like a Northport Lending, they are true brokers. So they typically do not have any in-house underwriting because they're going to send out your file or your client's file to another company that they're locking it with. That company is going to underwrite the file, clear the conditions, all of that. 9 times out of 10, that can be totally fine. But sometimes if there's a little hair on the file or something a little tricky with part-time income or something self-employed, that's where you all of a sudden hear the horror stories and you're calling mad at your loan officer. They're like, I'm so sorry, the underwriter won't get back to me. It's because it's not their company's underwriter. It's someone at a third party company. We also have the option to broker loans. We would only do this if it was something that no other Fannie Freddie investor wanted to touch. For example, a non-warrantable condo, a condotel, really weird self-employed income, or if they've only been self-employed for 1 year, we can definitely work on the loan. We can get it to the closing table. It just might take a little bit longer because it's a brokered loan and we have to send it out for somebody else to review. In-house underwriting, just touched on that. And then the AUS underwriting, again, that's the automated underwriting system that we run files through on every conventional FHA VA loan to know exactly what we need from the client. Some of you have probably heard of some of the loan programs we have. I just wanted to finish with a couple kind of unique things we have. Right now, we've got a 0 down payment program where an FHA buyer can have a score as low as 600. This is very different from Minnesota housing because Minnesota housing, you have to have a minimum of a 650 score. But the biggest thing is there's no income limits. So someone could be making $300,000 a year and qualify for 0% down. And the second mortgage is forgiven after 36 months. So they can take out to 5%, or if they only need 3.5% to offset the down payment and some of the closing costs, and that money is completely forgiven after 36 months of being in the home. This is an FHA backed loan, so that's the only thing we caveat clients with is the home would have to be able to get an FHA accepted offer on it. Minnesota housing, a lot of you are probably pretty familiar with this one. This is similar first-time homebuyer program, except for it can be compared or it can be paired with a conventional loan. So it's a little easier to get an accepted offer with than your standard FHA loan, but the credit income or the credit requirements are higher. And then there are income limits. So you can always pull income limits online at any Home Possible website is what it's called. But most of the income limits in the area, you have to be under about $88,000 if you don't want to pay back the second mortgage, or if you're above that, you have to be under $142,000 to qualify for the program altogether. In this market, it's kind of hard if there's a husband and a wife both working. Sometimes their incomes end up just being just over this, and so they don't quite qualify for the down payment assistance, which is then when we pivot to the other loan option with the FHA program. And then this has been a really unique one. I see Kelly on, we just looked at this for some of her clients too. This is a bridge loan where we do not have to count. So essentially someone could, if you have a client who's currently approved contingent, they could go look at homes non-contingent if we can get them pre-approved for this bridge loan, in which we just have to show their house is marketed and listed on the MLS, and then we do not have to hit them for that payment or the bridge loan payment. We only have to hit them for the future mortgage payment. The home does have to sell within the first few months of being on. So we want it to be, okay, we're sure this house is moving. We don't want to put anyone in an uncomfortable position, but it allows for that, especially the young family who's just in a pinch. This market is expensive, but they really need the extra space or they really need the extra bedrooms. This is a perfect solution for them. Does anyone have any questions or anything else they were hoping that I would chat on today? Kelly, Brooke, anything? Nothing. If you missed this and you're watching the recording, if there's any questions you have, feel free to email me, text, call. Obviously, my cell phone number is always on everything. We're always here as a resource. I think with this market, we do expect interest rates to stay at the threshold they're at for some time. It is stressful for clients. It is nerve-wracking. This is expensive for them. Every $30 a payment moves. They're already purchasing at the top of their budget. We need to make sure we're educating them, digging in with them, answering all of their questions, and trying to ease their fears as much as possible. So sometimes just getting ahead of all of this and explaining it on the upfront makes it so much more of an enjoyable process where once they're actually under contract, they are excited. They they do know what to expect as they're going through the process and they're crystal clear on how the numbers are going to work and there's no surprises. So again, if you ever have any questions, I'm always here. Otherwise, thank you guys for hopping on.